Warren Buffett, widely regarded as one of the most brilliant minds in the investment world, has consistently proven his genius through his remarkable track record and insightful approach to investing. With his down-to-earth demeanor and unwavering discipline, Buffett has amassed an empire of wealth through his astute investment decisions. His ability to cut through the noise and identify truly valuable opportunities sets him apart from the rest. Today, let's discover the hidden strategies behind Buffett's financial success. Possess an owner's mentality. From Buffett's perspective, investing in a stock is akin to acquiring a business, necessitating a thorough analysis and due diligence comparable to what one would undertake when purchasing a business. To illustrate, imagine someone offering to sell you their company for $5 billion. It's unlikely that you would simply hand over $5 billion without delving into crucial details such as the company's profitability, competitive advantages, growth prospects, risks involved, and necessary capital expenditure. Buffett's valuable lesson here is to avoid becoming excessively fixated on the stock price's recent fluctuations. Instead, devote more time to comprehending the underlying business driving the stock price. Once you have acquired answers to the pertinent questions, make investments in businesses that you genuinely envision owning for the next 10 to 20 years. The source of risk is ignorance of the situation. Many inexperienced investors are jumping into the stock and cryptocurrency markets without fully grasping their workings. Warren Buffett, a prominent investor, has consistently advised against chasing trends and instead focusing on comprehensible opportunities. Buffett himself avoided technology stocks for a significant period because he didn't understand how to value them. Only in 2016 did Berkshire Hathaway acquire a stake in Apple after gaining a thorough understanding of the business. Buffett's avoidance of technology sector didn't hinder his success, as demonstrated by the Berkshire Hathaway performance surpassing that of the Nasdaq over the past 2 decades. Coming to the next and most popular one. When others are greedy, be afraid of them, and when they're afraid, be greedy. The stock markets are subject to the ebb and flow of human emotions, often driven by cycles of greed and fear. During times of greed, people are willing to pay more for a business than it's actually worth. However, when fear takes hold, astute investors have the opportunity to acquire excellent businesses at significant discounts, provided they can set aside their own gloomy sentiments. Warren Buffett stands out as a prime example of an investor who has mastered this strategy and actively promotes its adoption among other investors. A notable illustration of his approach can be seen during the global economic meltdown of 2008, when fear cast doubts on the long-term prosperity of numerous businesses. Seizing the moment, Buffett swiftly made substantial investments in renowned companies such as GE, Goldman Sachs, Bank of America, Mars, and Dow Chemical. These strategic moves, estimated to have yielded a profit exceeding $10 billion by 2013, exemplify his shrewdness in capitalizing on market uncertainties. Never borrow money to purchase stocks. Warren Buffett, a legendary investor with an unwavering philosophy, is no stranger to expressing his exasperation over certain practices, using debt to fund stock purchases. In Buffett's eyes, when regular individuals resort to borrowing money to enter the stock market, they are willingly subjecting their livelihoods to the unpredictable whims of a volatile market. Even the seemingly steadfast stocks like his own Berkshire Hathaway are not immune to the capricious and brutal swings that can shake the very foundations of financial stability. Buffett's stance on this matter resonates with a mix of wisdom, caution, and a keen understanding of the market's fickleness, making it a thought-provoking topic worthy of contemplation. Always try to keep it in a simple mode. Warren Buffett's approach to investing is refreshingly straightforward and accessible. When it comes to his own investment strategy, Buffett adheres to a simple yet powerful principle: buy into businesses where the price you pay is significantly lower than the value you receive. It sounds simple enough in theory, but putting it into practice is no easy feat. Nonetheless, Buffett consistently emphasizes the importance of investing in instruments that are easy to comprehend and digest. To illustrate this point, let's take cryptocurrency as an example. If you find yourself grappling with an understanding of how cryptocurrencies like Bitcoin work, Buffett's advice is clear: steer clear of investing, trading, or speculating in them. The same principle applies to other complex investments, such as vehicles and futures, options, penny stocks, forex, commodities, silver, and the continuous influx of new and enticing investment opportunities that captivate our attention year after year. And by championing these approaches, he also encourages individuals to focus on sound, comprehensible investments that have stood the test of time. And that's all for now. Hit like to show your support for our work. Also keep in mind to press the bell icon and subscribe to the channel to never miss any future updates from us. We'll be right back in the next video. Thanks for watching and we'll see you again soon.